Hi, everybody.
So,
That's Trent Stremick. I'm with AgroSampo. We're doing business this year still as Armtech Insurance Services. For those of you who haven't heard, we have purchased or merged with Diversified Crop Insurance Services. So once we get into the 2020 season, we'll be known as strictly as AgroSampo North America. This new company does have a pretty worldwide platform. So we're getting a lot of nice products out of that when it comes to something a little outside of our normal windows of multi-peril. But so be aware of that. Once we get to the 2022 season, we'll be able to provide some of those. I'm going to talk to you a little bit today about the ECO options that we have this year. This is a new plan that was offered. Hide this. That was offered from the federal government. It's a high deductible type of plan, or remove some of those where it covers the shallow losses, looks at the higher ranges. So it starts triggering. There's two versions of this, either at 95%, works its way down to 86, as you can see there on the right-hand side, or you can buy just a 4% band, which is from 90 to 86%. This sits above your SCO if you're eligible for SCO. SCO we've had for a number of years. That's a supplemental coverage option. And what SCO does is it fills in from the 86% down to whatever level of coverage your multi-peril's at. So in this example, it's 75. So you'd have 11-point band there of SCO coverage. When you're thinking of this with the SCO, it's only available if you purchase PLC on a particular farm, then those acres on that farm are eligible for SCO. But ECO is available no matter what you choose at FSA because it pays down to the 86 and all the FSA programs don't start triggering until then. So this coverage sits above, so there's no duplications of these coverages. So that's why it's allowed up above. Just another quick one here that shows you can buy just the ECO. The green band there would be where the SCO would be, but it doesn't mean you have to purchase that. And like I said, if you have ARC purchased, you wouldn't be able to anyway. It can't be attached to any form of margin protection or area risk. If you're not familiar with these plans, they are county-based plans. So the county gets an offering. The county then will track production and pricing. And then at the end of the year, depending on what the county's done, it may or may not trigger a payment. ECO works in the same fashion. So does SCO as for that, for matter of fact. But ECO will sit up top. It'll be an area plan, meaning the county will get an offering. You can look in the RMA actuarials to see what these offerings are. It'll be based off of our multi-peril yields now, where it used to be based off of NAS. When it was the NAS data, that would be the data collected when they sent out those surveys to you, and you would fill those out and return them. We found those to not be very accurate, so they've now gone to the RMA for our multi-peril yields. So whatever is in the APH databases where we're pulling these. So you will see these yields truing up and being fairly reflective of your county. So you can look at that just to see how it's going to play out and see if it looks like a value to you. You can't put this on top of a CAT policy either. And then as far as written agreements, if it's not offered in the county, we can't do a written agreement to get it in place. High risk acreage insured by the underlying policy is insured by ECO. But you can, if you're familiar with this on your regular policy, exclude the high risk land if you wish to, just because of the costs associated with that. So if you exclude it from the policy, then it will be left off of the ECO side too if you were to purchase that. If you have an HR ACE policy, which is a high risk alternative coverage policy, if you have that, then you would also select ECO on both sides of that. So here's what we kind of mentioned before is the FSA programs. The FSA programs that you're signing up for, the ARC or the PLC, either one of those you can buy ECO coverage. Like I said before, the ECO sits above both of these, so it's not affected by ARC like the SCO was in the past. So what we're looking for here is protection against widespread loss of yield or revenue in the production area due to the natural causes. When they say production area, they're typically talking county basis. So we're looking at a county in particular. The entire county will need to suffer loss of either under 95% of that initial offering or 90% of it for this to kick in a payment. If you're looking at different practices, meaning dry land versus irrigated, under the irrigated practice, we typically don't see much of a yield loss. So what we're looking at there is primarily just a revenue type of protection. So if the offerings are pretty good in the spring and the revenues look fairly high, it could be something to look at to protect from that downward price movement. As far as payments, they get determined by the county average revenue or yield, depending on which plan you bought. They're not affected by whether the producer receives a payment from your underlying multi-peril policy, and it is possible to experience an individual loss and not receive an ECO indemnity or vice versa. So that's the main thing you have to take away from area plans, is since it's an area plan and county-based, your farm could suffer a loss, but the county could do well, and in that case, you would not receive a payment. Or vice versa, you could have a very good crop and the county underperforms and receive a payment. So one of the way to look at this is your farm typically, does it line up with the county? Does it sometimes perform better than the county? Then maybe these are worth looking at. If you're typically performing lower than the average for the county, or your land's in the tougher part of the county, sometimes these don't line up very well. So a few questions on the ECO. One is, do I have to purchase ECO from the same AIP as my underlying policy? And then yes, this is the case, just like SCO. The underlying policy endorsement must be purchased from the same company. The main reason for this is when the county triggers a loss, it'll percentage out that loss. So in our example, if we're looking from a 95 to an 86, and the county comes in right in the middle, for example, so we have a 50% county loss. We take that 50% and transfer that amount of loss over to your policy. So every individual unit structure that you have will have different varying amounts of coverage. We would apply this 50% to that range. So if you had $100 of liability, you would get a check for $50. If you only had 75 on a particular line, you'd get 37.5. So that's the main reason they need to line up, just for simplicity of following this stuff. You can do a percentage, coverage percentage to ECO. You're allowed to do this on your multi-peril 2 and on different policies that we offer. Basically what this is, it's going to say that you can buy a percentage of price. On these area plans, you typically want to get your trigger yield as high as you possibly can. So we're usually looking at the 95 level. If that premium looks high and you're saying, well, half of the dollar amount's fine, you can reduce that percentage to half by picking a 0.5. Or you can take 75% of the price. Whatever works out for you, whatever's best is the way you would look at that. So it is available. As far as multiple insurable types, this we kind of already touched on. This would be your irrigated, non-irrigated. They are tracked separately in the county. So they will each have an initial offering that'll be different from one another, and then they will track differently too. In your neck of the woods there in Nebraska, where the irrigation supply seems plentiful, yield typically isn't an issue unless you have I'll say an Iowa type event of last year, or severe early freeze or something like that. In that case, most of the times you'll find the irrigated practice will be purchased for revenue protection. It could be purchased, like I said, if the counties tend to trend the same, if you purchased it year after year, eventually this would give you fairly decent protection. As far as production reporting date, most area plans is the end of February. So ECO, SCO production reporting dates will follow the underlying policy. In your area where it's a revenue type of thing, you'll probably have to April as far as that goes. With that said, the main reason we're touching base on this is the fact that the payments will not come out until these yields are collected. So for example, if we had this available for the 2020 crop year, we wouldn't be able to make payments probably until sometime late May, early June, because we're going to be collecting this yield data up until the end of April and then need to be processed into May. So we're thinking payments probably won't be available until that June timeframe of the following year. So that's about it on the ECO and SCO. Just remember, it's an area plan, meaning not individual coverage. Look at the history of these as far as when they've paid out, see how it lines up with your farm. Most companies offer at least a 20-year history on what the county results would have been and whether or not these products would have made a payment. The next product we'll talk a little bit about here is band coverage. Band's a product we developed over the last few years. It's kind of more from what we used to have, a Revco and an APCO type product, to where we're now calling it band coverage. Band coverage, simply, if you think about it, is a band of coverage in a certain range. Just like the previous product, it's going to cover from, say, 95 down to 85, or you can buy a policy from 95 that pays out all the liability down to 50, spread that risk out a little, and help maintain some of the premium. So I'll give you a little overview of how this product works. So band also protects against the shallow losses and provides a reliable input cost recovery, a lower deductible. And when you're thinking deductibles, think of your multi-peril policy. If you're buying an 80% multi-peril policy, you're basically accepting a 20% deductible over what your normal yields or revenues would be. So in this case, what we're doing is trying to stack some additional coverage up above or along the side. But we will, in a lot of cases, look at lower deductibles. Main crops we look at are corn and soybeans. It is also available in sugar beets. Sugar beets, being a yield type of product, will be a side band, and I'll explain that a little bit. And then it is available on other crops in that side band formula too. So as far as varieties here on the coverage, you can have yield band. We're strictly looking at set yield. So if you have a 200 bushel APH, you buy one that starts triggering at 90%. We're looking at any yield under 180 would collect on yield band. And then down to wherever you have that band expiring at. Revenue band will be just like your revenue policies. So it's going to look at a combination of yield and revenue, and it'll mimic your RP policy. So if you think of it this way, if you have an RP policy at 85, but you truly want 95% coverage, you can do that with these products. You would now buy a band from 95 to 85. Your multi-peril then would go from 85 down to 0, and you would truly have a 95 to 0 type policy. The only thing this does not pick up is additional prevent plant coverage. So your prevent plant would still be just off of your base policy. There is also the revenue band with the harvest price exclusion. This will protect against loss of revenue caused by low yields or price, or a combination of both. With this product, the only thing to be aware of is if the harvest price is higher, we do use that price against that initial yield guarantee and dollar limit. So with harvest price exclusion, if the price goes down, it'll work just like a revenue product. If it goes up, it'll work a little bit differently. But it does give you initial upfront coverage to set a new floor or a higher floor when the projected prices are released. So some of the enhancements we have this year, we'll have option limits down to 50%. So you can do coverage ranges now to be 45% with the trigger as high as 90. Coverage exhausts once the loss exceeds a 50% loss in yield or revenue. And this will allow the grower to focus coverage on the top half of the crop. So this is like more likely to where your losses would occur. So you might look at some of these. The main reason for making that band deeper than just say the top 10% is to help mitigate some of those premium costs on these high coverage products. You can tailor this to your needs in 1% increments. So you can go from 95 down to 50, you can go from 95 down to 72, whatever you think would fit the scenario you're in. We also have added the coverage levels. We've expanded that. When we first released this product, it seemed like only the higher levels of coverage were interested, because they were most of the time looking at trying to put coverage up above the top. In this example here, you'll see the 90%. That is an area plan limit. On our multi-peril policies, 85 is as high as we can get. But now we're seeing some producers that are looking at some of the lower levels, say the 65 and 70s, because they've had an opportunity to contract. The contracts are above the multi-peril prices, so they're trying to put additional price on, and that's what we're using this for. So basically what we do then is line up a side band. Say we come in with $4 corn for a round number, but you found a $5 contract and you'd like to add $1 worth of coverage. In that case, you can go from that level down and add that dollar. You'd say, I want 25% of price, and you'd run that down from wherever you start your level at, 75, 80%, run it down all the way to 0, or run it down, say, just to 60 if you want to just cover the top half. Once again, we have 1% increments. Last year, the yield band and revenue band were limited to 5, 10, and 15%. That has gone up now since we've gone to the 1% increments. Policy protection factors are expanded also. That is the price that you would pick, a percent of price like we talked about earlier. So you will see some different ranges for that. The system will also default to not let you overvalue the crop, and I'll have a slide coming up on that to kind of explain that better. Couple of coverage elections, irrigated acres only, and then that high risk land exclusion that we talked about. And these will have to be elected at sales closing. There is a soybean exclusion clarification. So this is that FSC practice, which stands for following another crop. Basically, this is our second crop. What it's saying here is if second crop is an insurable practice in your area, then you can pick up band coverage on those acres. And you can kind of stack these if you wish with ECO and band. Since we talked about ECO being an area plan of insurance, you can have ECO and then individual coverage under band on the same acreage. We're seeing some producers interested in taking ECO at a 50% pricing and then putting a yield protection on the band type of coverage above or with that to protect both sides. As far as the application process, we do need to have these applications sent in, I'll say earlier than later. Last year, we did have a volume issue as far as what we were able to write, a capacity limit. These are all reinsured. They're all being high dollar, high coverage. So the reinsurers have put limits on the amounts of this we can sell. We think we're in pretty good shape this year with the prices being a little higher, that there won't be quite the demand there's been in the past. But just keep in mind, if you're interested in the product, the sooner the better. We'll need it to come in on a coverage application, and we'll need a quote to come with that. So we're going to generate a quote just to make sure you're aware of the premium. These products don't come very cheap. You'll see effective rates 30% and higher on a lot of these, meaning $30 per 100. Where we see them most useful, though, is in a situation where you need another $40, $50 of guaranteed revenue on the bottom. So you're putting a floor in with these products. So even if it costs you 30 to get 80, we've had producers that are willing to do that to pick up that extra $50 worth of coverage. So basically, you're going to work with your agent. You're going to submit that application with a quote. We're going to get that into our private product department, and then they will be approved or disapproved. They should be approved as long as we're not bumping up against capacity limits for a certain area. These are the additional crops. Yes,
Trent,
sir.
I do have one question there. Can they buy those? Are those just area plans, or can they buy them on an individual basis?
So all the band products will be an individual basis. So that will come off of your policy directly and be reflected to that. One other thing to mention about that, you can change up the unit structures too with these. So if you want to, say you have an enterprise setting up to 85, but you want some individual optional coverage, you could do an optional basis up above that. Or vice versa. Perhaps you want to put some optional coverage down below to get some spot loss in place. But due to costs, then you'll put an enterprise unit above the top. But this will be all individually based, the band products, off of your particular farm or entity that you're farming under. So as far as the additional crops, here's kind of a list of them. Not that they're the most common crops, but there's a few in there that you might be raising. These, you'll see that second bullet says the band loss trigger must be equal or less than the multi-peril coverage. This is where I was talking kind of the side band. So say you have dry beans, you buy at a 75 level policy, and you want some additional pricing on that policy, you could buy a band on the side that starts at 75 and then pick up additional price. And then that 75 you can run down all the way to 0 if you wish, or you could run it down partially. Say you just want to cover the top end of it because you expect to raise at least half a crop. So you'd pick a band from 75 to say 50 in that example. If you do want to insure some of these other crops, make sure you're getting these in early so we can review them and get approval out to you. It takes a little more time and to look at this, make sure the rates are correct, and to make sure that we have the capacity for them. So like I said, for that, give us at least 2 weeks prior to the sales closing date. The sales closing date is the same as the multi-peril date. So right now we're looking at a March 15th. So by the 1st of March would be ideal if you're looking at additional crops, say dry beans, spring wheat, if you're on the South Dakota side, something like that. We'll just show you a few loss examples to help explain how the product works. We'll start off in corn since this will be one of our more popular crops. We're going to do an approved yield of 200 bushels. We use $4 just for round figures. Right now it is trading or trending right around 450 this year, so that's good. If you can see here, the loss trigger is going to start at 95, and we're going to have a 10% coverage range or a 10% band is what we're looking at here. We did buy 100% of the price, so if you look down towards the bottom, our multi-peril coverage, we have 680,000 at our 85 level. We're going to pick up another $80,000 worth of coverage on the 10% band. So basically, we're putting a floor in on this policy at 760,000 less whatever applicable premiums we have. So when we get to harvest with this crop, here's our crop value at 100%, 800,000. Here's our multi-peril, 85%. That would be you're taking the 15% deductible, so to speak. We're going to fill in a lot of that deductible with a 10% band on top. So now we have effectively 95% coverage for our planted crops. At harvest time, for this example, we'll say the price didn't move, so we have a steady pricing. We came in with 196 bushels. As far as production goes per acre, that's above both of our trigger levels, meaning we ended up with more than 95% of our expected revenue. So in this case, neither one of the products would trigger a loss. But say we come in at 170 bushels. At 170 bushels, we're right at our multi-peril guarantee. So we have zero loss on our multi-peril, but we picked up our loss on our band because we put this band up above. So we did collect the 80,000 when we came in right at our current multi-peril guarantee. When our losses get deeper, then both products will start to pay. The band will max out when we hit the 85 level or 85% of value, and then the multi-peril will protect you from that level all the way down to zero. Second example, I just want to show you how you can kind of set this up differently if you wish. Same thing here, we have our 200 bushels at 4, but in this case, we actually stuck our 5% band up higher. So we're going to manage our premium a little bit. We're going to put our trigger up high, so our trigger's at 95%. When you get up here, the 90 to 90, 95 to 90, the 90 to 85 aren't priced that differently, just due to the fact that there's not much subsidy left on the multi-peril side. When we get up here, it follows true even on these unsubsidized program or policies. We have seen in the past where some producers actually drop their multi-peril to 80 and then throw this 5% band above it because without the prevent plant charge in there, it actually worked out to be a little bit cheaper in some counties. Same example here, since we only bought 5% band, we only have $40,000 of effective coverage because we basically bought half. You'll see our total at 720. 196 again, we would not have a payable loss because we're above our guarantees. If we come in at the 170, still nothing on the multi-peril, but we did pick up our 40,000 on top where the band coverage was. And then the same thing as we drop down into deeper losses. Here's where our multi-peril starts to kick in. This one, I'll just kind of show you how that side band works a little bit. So in this case, what we're setting up is right there, a 45% band. We're going to start triggering up high at 95%, but we're not going to find all the liability or pay out all the liability on crop until our crop gets down to half. One of the benefits of doing this is you can pick up a little more dollars of coverage overall for an extreme event. So you can see here where our multi-peril still at our 680, but instead of the band being limited to 80,000, we're now at 118,800. A couple things the RMA will not let us do. They will not let us trigger above 95%, and they will not allow us to go above the current price that's projected. We have to take a percentage of that, or they will not allow that total dollar revenue on a side band like this to exceed the crop value of 800,000 in this example. So you can see here when we do these extended bands, we put a 33% price protection factor on here. We actually got up to almost 800,000 of max coverage. As far as our loss scenario, same thing, 196, you're still above either trigger point, so no losses in that case. But at the 170, you will see where we're going to start picking up some of that band loss. We won't have the full 80,000 or the full 118,000 like we had before, just because our loss is less than a fourth. But as the loss deepens, you will see that band start to pick up. And if we got down to where we had a 100 bushel crop in this example, we would max out that band liability. And then here's just another example that's kind of the same as far as the side bands, but in this case, we only did a 25% protection factor. That gives us less coverage. It brings it down to 90,000, and then you'll see the same exact scenarios here to where we pick up partial payments on that. So that's the private product that we offer through ArmTech. Think of that, like Rich asked before, as an individual plan that's tailored to your farm, works off of your yields, off your guarantees. So nothing to do with the county, strictly how your farm performs. Another thing with the payments on these, we don't necessarily have to come out and adjust these depending on where the situation is. If the loss is shallow where it doesn't get into your multi-peril, we will wait for your production records to come in and then pay accordingly off the production records. So if you know you're in that loss area, the sooner those production records come in, the quicker you'll see a payment on that. So this will be different than the ECO. Once we determine your yields, then we're able to pay this.